So let's start the second topic, and the second topic is income effect of a denominator level of on inventory valuation. Now, this chapter is related to one thing, that how we deal with the fixed cost. If the fixed cost is distributed towards the product cost, then the fixed cost is going to be a part of an inventory. And by this way, we get the profit, which is different than if we charge the fixed cost separately and we treat them as a period cost. So that's the main idea of this chapter, is the income effect of a denomination level of inventory valuation. Inventory valuation means that if we fixed cost add up into the per unit cost of the product, then definitely we will calculate the cost of goods sold differently. We get a different values, and by this way, the income is going to come with a different value. And if we add up as a period cost, then we will get different value. So we will go over this. What's the difference between product cost and period cost? What is a method we use as a variable cost method or a absorption cost method? So this is the way we just an introduction that what we are expecting in this or what you can expect from this topic. So what are the learning objectives of this? And I make the PowerPoint because to read it more effectively. Yeah, this way it's going to be a little bit bigger. I can read it more. So learning objectives. What are the learning outcomes from this topic is identify the factors important to choosing the denominator level used to calculate the fixed overhead allocation rate. So fixed overhead allocation rate is our target to discuss. Explain how the choice of denominator affect capacity management, costing and pricing, and performance evaluation. So again, the objective is to provide the management accurate information so that they can make a good decision based on that information. You know that managerial accounting, the main idea behind the managerial accounting is to provide management accurate and effective information so that they can make a good decisions. That is the main objective of a managerial accounting. Uh, on the other hand, sorry, on the other hand, financial accounting have a very different objective. So they want to provide information, correct information to the outsiders like investors, lenders, other stakeholders, regulators, and all these. So that's a perspective. That's what I am why I'm mentioning this here, that uh, capacity management and costing, pricing, and performance evaluations. So all these things are related to the management, internal management. Distinguish absorption from variable costing. So as I mentioned, that there's a issue of the method we can use is as an absorption costing or a variable costing. Uh, Prepare and explain difference in operating income under each policy. Now there are four different categories through which we can identify or we can use in our reports. One is called as a theoretical capacity. Like theoretical capacity means what is written that they can perform up till that point. So if you look at your car or your vehicle, there is an odometer, and odometer is going around to 210 or 180 or something like that's a theoretical capacity of a car to go up to that speed. But in practical, we never touch that. In practical, we never touch that. Practical is that we drive it 100, 120 maximum. That's so. In this example, just to give you an idea that what is practical, what is theoretical. So theoretical possibility that you can take it to the 200, but practically it is not possible. So ideal situation with no delays or shutdowns. So that's a theoretical capacity. Practical capacity, amount of output practically possible, including shutdowns for maintenance, inspection, and all these things. But the normal capacity that we drive the cars around 60, 70 kilometers per hour. So that's a normal capacity, satisfies average customer demand over several periods and complies with International Financial Reporting System or accounting standards for private enterprises, ASPE, right? So this is the way that it works. Theoretical, that's very different. Practical, that's a different. Normal, below practical, and there is a master budget capacity. That's the capacity we plan that this year for a very specific one period, we define that, okay, we're going to want to produce this much, and that's the within our capacity, so we can satisfy customer demand in a one period and tax requirements. So this is the way that we differentiate these capacities: theoretical, practical, normal, and budget, master budget capacity. The reason this capacity supply theoretical and is greater than practical. So we know that capacity management, inventory value, product cost, and product pricing, these are all things based on our capacity and practical capacity and theoretical capacity. But when we are operating and when we are dealing, so we see that the normal capacities are normally bigger than, because the normal capacity is an average over many periods, and master budget capacity is a one specific period. So why we do need these performance evaluation for a one particular, like this is our normal that we produce 100 units, but this time we produce 90. So then we can ask the question to our responsible managers, then why we are producing less than as compared to our average from the last 2 years, 3 years, which is a normal capacity. So this is the way that we can use to evaluate performances and also internal variances to find out where the variance is, and external governance and financial reporting. So these are the things which are related to these two capacities are related to these issues, and these two capacities are related to this issue. Now, for any standard product, we see that the product life cycle, life cycle is such a topic which is applicable to everything, including ourselves, including whatever you have. There is a life cycle for that. There is the humans. If you take human as a example, or any animal, or any tree, or any even non-living products as well. So there is a start time, there is an end time. For everything, there is an end time. So same is the case with the products when you are dealing or selling your goods or services. So there is a development phase that you are developing a new product. Then you introduce to the market. Like in the development phase means that you are doing R&D at your own level, and when you figure it out that, okay, this is a product which we are able to sell, so we introduce in the market. When we introduce, and if the product is a good product, so definitely what is going to happen, the demand growth, and demand grow will reach up to the point where there's a maturity. After maturity, definitely there's a decline. We can see in our different products, like if you look at some games, computer games, or the when they introduce, then there is a demand for it, and then people get bored with it, and then it starts declining. For cell phone, different models arise. They grow, they increase in demand, and then reach to the point where there's a need of a new thing, and then new product launched, the old one is going to be died out. So this is the way that it works. So using theoretical or practical capacity as the denominator, reduce. Now, if we use the theoretical capacity for our calculations and finding out the cost, that is not going to give us a correct information. Like reduce the amount of fixed manufacturing overhead assigned to inventory. Like, for example, if and the example which I already mentioned, for your car, your vehicle, if you look at the theoretical capacity like 200 kilometers per hour, and you divide the gas expenses of your gas expenses with 200, or your maintenance expenses like engine oil or brake oil or all these things, with a 200 or 210 kilometers per hour, then you get a very low fixed cost per hour, per kilometer. But that's not the true, because as a common sense, we have to divide it with the way that we are using. What is the normal use of that? So that's the way that reduce the amount of fixed manufacturing overhead assigned to inventory and increase the production volume variance. So this is the way that it's going to increase the variance. Generally, variance from actual and the theoretical one. So generally, the lower the capacity amount used in the denominator, the higher the fixed overhead rate and higher the cost assigned to each unit produced, and lower the production volume variance. Capacity, product pricing, and performance evaluation. Now, why we are relating with the performance evaluation? Because the managers are getting bonuses and all these things based on the profit they are generating or their department is generating. So using master budget capacity can lead to a downward demand spiral. When sales decrease, master budget fixed overhead rate increase cost and price, leading to further sales decrease. So if we increase the price, if the sales are already decreasing, and if we increase further the price because the cost is more, so what is going to happen? The sales further go down. So that's a spiral effect if we apply the master budget capacity. So using normal capacity provides no meaningful feedback on the performance. Normal capacity is an average over several years, but performance is assessed more frequently. So what we have to do, to make a choice between whether we are using variable costing or absorption costing. So these are the two methods we use in order to calculate the cost, which is related to the product. So all variable manufacturing cost, direct and indirects, are included as inventoriable cost. When we are saying inventoriable cost, means that we are adding towards the cost of goods sold and cost of goods manufactured, and out of which is sold is subtracted, and the rest is the inventory. So how much cost we have to add towards that? So in a variable costing method, we add all variable manufacturing cost, whether it is a direct or indirect. But in absorption costing, we do all manufacturing cost, whether it is variable or fixed, are included as an inventoriable cost, and all non-manufacturing cost, variable and fixed costs, are expensed out. So the main difference between variable costing method and absorption costing method is that in a variable, we just add up all the variables which are related to per unit, and then we treat it as the cost of goods sold or cost of goods manufactured. But in absorption costing, we are not saying whether it's a variable or non-variable, or a variable or a fixed. But what we do is that we add up all the manufacturing cost, all manufacturing costs. So this point here, which is in red color, is a variable manufacturing, and we are saying here all manufacturing cost. So that's the main difference between variable costing and absorption costing. Product costs are capitalized, and all variable and fixed manufacturing costs are included as an inventoriable cost. That's a product cost. And period costs are expensed, like every period we expensed out. We are not capitalizing that. All variable and fixed non-manufacturing costs are classified as period costs. So now again, in absorption costing, we divide the cost into two. One is a product cost and the other one is a period cost. So product cost is related to the product, and period cost is not directly related, but it is we have to pay, like the salaries of the managers, like the salaries of the supervisors, like a rent of the factory premises. All these things are called as a period cost. All variable and fixed non-manufacturing costs are classified as a period cost. So cost of production transferred from inventory to cost of goods sold when the goods are sold, also referred as a full costing. This is what we call it as a full costing. On the other hand, variable costing is the product costs are capitalized. All only variable manufacturing costs are included as inventoriable, and period costs are expensed. All fixed cost. So the main difference is they also divided this between product and period cost, but all fixed costs are period costs. They treat it as all fixed costs are period costs. But here we are not saying no. The all, whether it's a variable or fixed, if it is non-manufacturing, then it is treated to be as a period cost. So variable cost of productions are transferred from inventory to cost of goods sold when the goods are sold, also referred as a direct costing. So we use here two words, variable costing and absorption costing. And we further divide this variable costing and absorption costing into two, the product cost and the period cost. The main difference between absorption costing and variable costing is that the period cost for variable costing is having only fixed cost, whether it's manufacturing or non-manufacturing. But in a absorption, we make it very clear that all variable and fixed costs are non-manufacturing are including into the period cost. And we use the word direct full costing or the direct costing as well. So what is going to happen that the income is going to change when we use different methods, absorption costing method or a variable costing method. So operating income will differ between absorption and variable costing. The amount of the difference represents the amount of fixed product uh, capitalized as inventory under absorption costing and expensed as a period costing under variable cost. So what is going to happen? Like if we compare comparative income effect, are fixed products cost inventorized in variable cost? No. In absorption costing, yes. Is there a production volume variance in variable cost? No. And in absorption costing, yes. Are classification between variable and fixed costs routinely made in variable costing? Yes. And absorption costing infrequently, not so much. Now, what is happening to the income? How do change in inventory cost affect operating income? If production and sales are equal, like there is no inventory, like production and sales are equal, then the profit out, whether we are using variable costing or absorption costing, is going to be equal. This one, there is no difference. There's no variance. But if the production is more and sales are less, it means that there is an inventory. And in that case, what is going to happen is the variable costing method lower the income and absorption costing method higher the income. And if the production is less and the sales are more, like we are selling the inventories of the last year, then what is going to happen? Because the production is less, so it means that variable costing method represents a high profit and absorption costing method lowers the profit. So this is the way that it works. Like in a variable costing method, what we do, we revenue, both in both method, revenue is same. The only difference is here, we are here subtracting variable cost and get a contribution margin. And then we subtract the fixed costs and we get operating income. Standard one, a variable method. The absorption costing method is saying we not subtract the variable cost. We also subtract the fixed cost, which is related to manufacturing. And for that reason, we are saying it's a cost of goods sold. So when we subtract the cost of goods sold, we get it gross margin. And from gross margin, we have to subtract the operating expenses. And by this way, we get it operating income. So difference in operating income, absorption costing, operating income minus variable costing operating income. So if we find out the difference of these two, if we calculate the income from both the methods, the difference, this minus sign reflects the difference, is equal to the difference between fixed manufacturing cost in ending inventory, minus fixed manufacturing cost in the beginning inventory. So the only difference is because of the fixed manufacturing cost in the beginning and the ending inventory. Now here is an example. Like if you look at this table, we see here. So we see here that we are talking about a company, Radius Company, and we are preparing the income statement for 2 years, 2018, 2019, and we are using one as a method for the upper portion is having a variable costing method, and the lower panel is representing a absorption costing method. So we see here that the profit with the operating income with the variable costing method in 2018 is 1.22 million, and it's with the absorption costing method it is 1.5 million. Same is the case with the 2019, and we see the difference. And the difference is because what we just discussed. So managers may ask to manipulate income by producing too many units. That's a possibility that if we are performance issue in absorption costing method. So if we are using that, those, so you see here, like if we are producing more in absorption costing, the profit is going to be higher. And by this way, what is going to happen that it is in the interest of the management to produce more, and by this way they can show more income and they get bonuses. So production beyond demand will increase the amount of inventory on hand, which is not good for the firm. So although that shows more profit, so this will result in a more fixed cost being capitalized as an inventory, and that leaves a smaller amount of fixed cost to be expensed during the period. So over operating income increases and potentially so do management bonuses. So that's the objective. Under absorption costing, there is a incentive for the management to overproduce, and by this way they can get bonuses. So one way to prevent the unnecessary building up of inventory, because inventory buildup is a possibility under absorption method. Um, Buildup of inventory of bonuses purpose is to base managers bonus on profit calculating using variable costing method. So performance should be evaluated on variable cost method. But the problem is that you cannot maintain two different types of books. That creates a problem. So other manipulating schemes beyond simple overproduction is that is also possible under absorption system. Uh, Deciding to manufacturing products that absorb the highest amount of fixed cost regardless of the demand, and this is what we call it as a cherry picking, or they pick the low-hanging fruits, and by this way, by this way they can make. So accepting an order to increase production, even though other plants in the same firm is better suited to handle that order. So that's or deferring maintenance. So they avoid maintenance because maintenance is a variable cost. So why they fix. So then change the accounting system, use variable or throughput costing system, careful budgeting and inventory planning. So it's good that we use variable costing, incorporate carrying charges for inventory, change the time period, include non-financial and financial performance measures so that the managers are not overproducing. Throughput costing, also known as super variable costing, only variable direct material are capitalized as product cost. All other costs are expensed as a period expense when they are incurred. So reduce the motivation to increase inventories, and reduce inventory levels means less fund for are tied up in the inventory. So this is that how the actual costing, normal costing, and standard costing under variable direct manufacturing overhead cost and fixed direct manufacturing overhead cost and fixed manufacturing overhead cost. So this table is explaining or comparing what we discussed so far. So it's just a summary and brief of comparing the different costing. So actual costing, variable cost, normal costing, and standard costing under variable costing method or absorption costing method. So one break-even point depends on fixed cost, contribution margin per unit, and unit level of. So when we are saying break-even point means that a point where there is no profit. So total fixed cost plus target operating income divided by the contribution margin per unit. That's a break-even, one break-even. A function of sales. As sales increases, operating income increases. Absorption costing break even more than one depends on fixed cost, contribution margin per unit, unit of level of sales, unit level of production, overhead cost. So we can use these measures, a function of sales and production both to in order to avoid overproduction and all these things. So this is the main idea of this chapter, which we discuss is regarding absorption costing and variable costing. And also we have to see the difference between product cost and period cost and how this variable costing and absorption costing is affecting the management decision to produce how much and we have to be careful when the management is using absorption costing method that there is no overproduction, and because of overproduction there is a possibility of building up of inventories. So this is all what I want to share with you today.